Welcome back, my passive income investors. I like to an in-depth review of my restructured $323,000 dividend stock portfolio, of course, for that juicy passive income. But before we get into that, let's talk about the broader view of the market, because the S&P 500 has been finding more and more stability as time goes on in this upward trend, as this kind of the trend line becomes tighter and tighter. And we can also see this in the volatility index, which represents the volume, and that has nominalized over the last few months, even with all the geopolitical issues, what's going on with China, inflation. This is something that I was largely under expecting to be happening. And a lot of people will immediately go to the S&P PE, say things are expensive because we haven't seen these valuations since the dot-com bubble, the 2008 financial crisis. But the reality is companies didn't have actual revenue and EBITDA back in those time frames. So today, I honestly think the market is trading for fair value. For as long as tech giants keep posting earnings that penny stocks wish they could post, this PE honestly makes sense to me, guys. And on that note, let's just talk about how I've structured my portfolio around this, because I think this exodus from small caps and people recognizing the value of large caps is going to be a trend that continues for a little while. I know that's something that Jeremy doesn't really agree with. You know, financial education, he was highly involved in small caps, Tattoo Chef, Corsair Gaming, and even those companies trade at way better valuations, I think people are still rather shifting into these larger caps. So this is kind of how I've been weighting my portfolio. We're going to start from the top down. As many of you know, I sold out of my sin stocks, my tobacco giants. I do not trust their fundamental business anymore, and I would rather be structured in companies that are continually footholding new innovations. So I put a lot of that money into the VOO, giving me a larger exposure to the large caps, but in a more diversified manner. I think it's appropriate to start adding index funds at this stage in my investment career. I mean, we're taking a look at Apple, Microsoft, Facebook, Google, Tesla, making up now a whopping 30% plus of the entire portfolio. The total valuation, including the index fund, give me a weighting of about $108,000. These are the gems, the growth vectors of this portfolio, and we can just take a look at how they've done this year. I mean, Google's up 60. Could you imagine one of the largest companies in the world giving you a return of 64%? And it is following the same trend as something like the S&P. Facebook here up 36%. Tesla flatlining. Obviously, this one is the most debatable of my growth positions. We got Apple in here up 14.3%, actually underperforming the market, shockingly. We got Microsoft up almost 38%, guys. And then, of course, the VOO up 21%. The way I look at this percentage weighting of my portfolio, that if it continues to grow at that 20 to 30% rate, which I don't think is going to be sustainable forever, but in the meantime, I mean, that's easily giving me a growth of $20 to $30,000 on this 100K invested. And if we actually just scroll down a little bit before I touch base on the dividends, guys, I've actually worked out the weightings. So we can see that 79% of my portfolio is in dividend plays, but that also includes Apple and Microsoft. I've only got 18% in pure growth plays that don't pay dividends, including Bitcoin as well, with Google, Facebook, and Tesla. And then, of course, 3% right now is kind of where my cash weighting sits at. But we can actually see the tech weighting is at 31%. That includes Bitcoin for that matter. But let's just take a fuller overview here and start talking about these dividend stocks, because in my transition to basically stabilize the long-term potential of my dividend income, I had to take some cuts, because again, I don't trust the tobacco sector and I want to be more weighted in healthcare. So what I ended up doing was, many of you know I already have exposure to J&J. I sold out of Lockheed Martin, a few of my other positions, to buy Clorox, because I feel like this is a solid consumer staple brand that has a lot of healthcare exposure. It is trading back to its 2019 levels, even though through the pandemic it grew its revenues by over $8 billion. And yeah, they have some supply constraint issues as well, but I really like kind of getting more into the healthcare side of things, because that's going to be a prevalent conversation probably for the years to come still. So what I went ahead and did with some of that MO and British American Tobacco money is I threw it also into MPW, which is Medical Properties Trust. It's a REIT that only owns hospitals on triple net leases. So they just kind of cash flow in an incredible way with their leases going up for the next decade. I love this company for, it's not monthly cash flow, but it's enough to keep me happy. So I loaded up a bit more of that as well. And you'll notice that I've been working very aggressively to ensure all my positions in this portfolio make up a real severe impact. Unfortunately, as I mentioned to many of you out there, it doesn't make sense for me to be throwing a few thousand into a penny stock or this or that. I need real high convictions here, because every company has to offer something to the portfolio. And we can see All of my weightings are well over 10,000. I have nothing below except for currently my Bitcoin position. But putting that lower position aside, guys, this is what I've always wanted my portfolio to primarily be like. And you OGs have seen me restructure out of tech and now kind of going back into tech here. But overall, with all these dividends kind of accumulating, is going to be annualizing about $7,773. I ran the math after tax because some of these dividends have tax implications, and it's actually closer to about $7,400. And the coolest thing about my dividends is in my tax advantaged accounts that I have free access to as a Canadian, I will still be cash flowing $500 a month that I can literally use tomorrow if I absolutely needed it. So I think structuring my portfolio to try and get about $20,000 to $30,000 of growth a year for as long as this continues, plus this extra 7,000 in annualized income, should give me roughly, because I never plan on selling my dividend stocks, about $27,000 to $37,000 of income with the growth. And that, I think, is well stabilized enough as a backup reserve income for me. And again, when we look at the dividend structure here, I've done everything I can to ensure that it is going to last. I think people kind of chase high yields too much in options funds, and those options funds, the higher the yield gets, guys, you're always giving something up for it. And honestly, I would rather take a much lower yield, knowing if I went in a cryogenic freeze, that it's with the highest degree of certainty that those dividends are not only still going to be here, but they are going to increase. And we can kind of just take a look at the pie with the largest percentage of my dividend income coming from Ryokan still, which is one of the reasons I had to pull back on it a few months back. As many of you remember, I just can't have my entire, my supplement income coming largely from one company. Even though I trust that company a lot, I think they're going to be okay. It just got scary. So you guys might remember I scaled at 33% down. So now it sits at a 13% weighting of my overall income, which is still relatively large. But you'll notice that my entire income is basically weighted between kind of like consumer stapled products. I have a tiny hint of telecom, largely stapled in banks. Banks make up a huge percentage, about $42,000. My REITs make up about $50,000, and then my utilities, also one of my favorite sectors of the portfolio, make up $46,000. So you can see that these sectors that I'm most drawn to for stabilized dividend income are relatively foundational, right? Like we're talking real estate, we're talking utilities, we're talking consumer staple brands like Pepsi, J&J, Clorox. These are things that make me sleep so comfortably at night, even though my yield on my portfolio has dropped drastically. Like I said, guys, I know that that is foundationally insane from like the closest thing to guaranteed income possible. There's nothing guaranteed here, folks, but if you want to help guarantee my income and you enjoy the way my portfolio is mapped here, we have even more advanced portfolio trackers that we've spent hours, literally months of research, having people review them and remaking them over at thechartmaster.com. Use coupon code passive income investor, 15% off. You buy one of these, you get all of them for free, except for the crypto tracker. If you buy the crypto tracker, you will get all of them, but if you buy another one, you don't get the crypto tracker. This one was built by a third party, and the guy seems pretty excited about how it integrates into his stock portfolio as well. But I love having this spreadsheet, guys, because I think it's so prevalent to understand your risk tolerance and how you're structuring your portfolio, as I try not to make anything have much more than an 8% weighting at most in this portfolio. OGs remember Ryokan was at 13% once. Real OGs will remember MindMed was at like 20% of my portfolio, I think, once upon a time. But now, oh my God, when I look at this, guys, this is what I dream about when I'm structuring a real portfolio. Nothing makes up relatively more than 7%, and the companies that do are some of my highest conviction trades. Microsoft being my largest tech giant now, not by choice, just by happening, because my goodness, that thing had a run, makes up $22,000 in Canadian value for the portfolio. But for the way it sits right now, folks, I honestly feel like I don't have to look at this as often as I did. I don't feel like I have any crazy exposure except for Tesla, and that's one of my highest conviction trades. But I really want to pass the question off to you. How do you guys feel about my portfolio structure? Is there anything that you would personally do different? Would you consider adding more Bitcoin here? I'm still looking into the mining aspect of it. That's a conversation for another day I may bring up. But this makes me feel so great, guys. So stay cool, stay awesome, and I look forward to catching you tomorrow.